Hey folks, welcome back to the channel. And it's been a pretty crazy week in the stock markets. If we look at the NASDAQ, we can see that since April, it's just been going down. So that's one, two, three, four, five down weeks in a row, which normally does not happen. On Wednesday, after some good news from the Fed, almost every stock was up. But then the following day, almost every stock was down. Did the fundamentals of these companies like Apple or Amazon change 5, 6, 7% on a daily basis? Of course not. So it's just sentiment in the market that's driving these price movements. And it can feel pretty bad looking at the markets. So if you bought in at the high point, you're down about 25%. However, if it looks bad right now, just zoom out. And as long-term investors, that's one of the things we have to do is to keep perspective in mind. Generally, the stock market does go up and to the right, but sometimes, as you can see throughout history, we do have these dips, and that's going to be par for the course. You're going to have to expect corrections along the way. In terms of what to do right now, I think one of the worst things is to panic and sell. The reality is it's very hard to time where that bottom is going to be. So on the one hand, we don't want to try and catch a falling knife because this could turn from a 5 week drop to a 6 week consecutive drop. So from a dollar cost averaging perspective, I wouldn't put all of my money in at this point right now, but waiting for the market to bottom out before you start buying, it's probably not going to work out. So what I like to do is use time to kind of cushion that downward risk. So in other words, I probably buy a little bit now and uh, wait a couple of weeks and then buy some more. Maybe the stock market's down here at that time, and then wait a couple more weeks, buy some more. And then if the market goes up, I would buy some more there. So I'm basically using time to average the cost of my shares and trying to get it at a lower price because I don't know where that bottom is going to be. What I don't want to do is put everything in the market right now, and I don't have any more to dollar cost average in. And if the stock market continues to drop like this, then I'm basically going to lose all of that. So I think spreading out my purchases over time is a good idea. And the way I'm doing that is through options, which I'll explain in a bit. But generally, if I'm not using leverage, if I'm not using options, then this is the way I would buy into the stock market right now. Now, the good news is we are seeing some signs that we could be hitting a bottom soon. For example, on the Trading Economics website, this is the inflation rate in the US over the last year. But down here, we can look at what the next reading could be. The consensus for the April annual rate of inflation is 8.1. So we'll have to see. This is basically in a few more days on Wednesday. We're going to get the number out for April. And if it's below 8.5, then that means the rate of inflation has probably peaked. Maybe the Fed doesn't have to raise interest rates as aggressively anymore, so we could see multiple expansion again in the stock market. Another indication that the worst is behind us, if we look at the purple line here, which is the 200-day moving average, we can see that for at least the past 2 decades, the stock market, again, looking at the NASDAQ here, pretty much stays above this 200 EMA, and sometimes it does drop below it, but that's usually short-lived. The only outlier was the 2008 2009 financial crisis, and we had basically a year where the NASDAQ composite was below its 200-day EMA. But then after that, it was pretty much above all the time. In 2016, it came close to that purple line, but basically just bounced off of that. In 2018, there was a brief bear market. The index came down, again, almost touching that line, but then it just bounced right back up. So, where are we sitting today? We're getting pretty close to that purple line. I would say there's another about 6 or 7% drop before we actually hit it. Doesn't mean we will hit it because, many times in the past it came close, but didn't actually hit that 200-day EMA. However, we have to be prepared that there is a chance that the NASDAQ composite could hit that line, which is at around the 11,300 mark. And that's about a 6 or 7% decline from what it is today. So the good news is most of the pain is seemingly in the rearview mirror because we're already down 25% from the peak. So another 7% is not a huge deal. So I'm looking at this bar and I'm thinking if it falls down to the 200-day EMA, it will either bounce, in which case, if we see like a couple of green consecutive bars, kind of like this, then that kind of shows that that's pretty much the bottom at 11,300, basically the 200 EMA. However, if it falls through that, I mean, there's kind of a band over here just from the previous years, like in 2020, we can see we have a high and a low and it basically just bounced up and down there. So we could get within that range again if it falls through the 200-day EMA. So most likely it will not go past that. And then the third sign that we're kind of near the bottom, when we look at the volatility index, the VIX, and this measures how volatile the stock market will likely be going forward. So in 2020, the market fell about 30%, and we had a huge rise in the VIX. But once it's reached a top, it starts to go down, and the next peaks that it makes, it's lower than the previous really high peak. And so that's how we know the VIX is dropping and the market is getting less volatile. And what's happening this time is I think we've seen a really high spike in the beginning of this year around February. So the VIX went all the way up past 35 here. We're basically looking at the top of this upper wick and it went down and it went up and peaked again, but it's lower than the first peak. And then it dropped and it went up again, but it's lower than the first and second. And then it dropped again and now it's up, but again, it's lower than the first 3 weeks. So again, we're seeing that really high point, and then the next peaks are going down. So if this trend continues, then the most volatile part of the market, at least for now, is over. So this is another indication that, not necessarily the market has bottomed, but it's definitely trying to find a bottom. And I'm guessing it's going to be around this month, sometime in May. And historically, when the VIX is above 30, like it is right now, if you look at 1 year after this happens, the S&P 500 had a return about 90% of the time. So those are pretty good odds. And the average return was 23%. Chances of making a profitable investment right now, if you put your money into the market, is much better than like 6 months ago. So, other than just dollar cost averaging into the market, another idea that you can use if you're comfortable using options is to sell um, put options basically, but you want to sell them really far out of the money. All you're trying to do when you're investing for the long run is to just catch this growing trend. And if you imagine this purple line here as the actual value of the company, the intrinsic value, which isn't actually going to be a straight line, it might be like a curved line, but it's something like this. And the stock price is just going up and down. And sometimes people are really into the stock, like here, and sometimes the stock is underpriced, like right now. And ideally, you want to try to buy the stock when it's below this line, which is not always the case, but I think right now there's a lot of good opportunities to do that. So last week I mentioned I was going to buy risk reversals for Shopify and MetaFast. So let's see how those turned out. On Monday, I sold a put option on MetaFast at 145 strike, and I purchased a call option with a 190 strike. So I received some premiums from selling the put, but then I also spent money to buy the call. And overall, my net premium spent was $450. And the next day, after MetaFast produced earnings, the stock went up. So that's what I was expecting, and I was able to close out my position for a net of $1,100. So this basically meant a $650 profit in basically 1 day of option trading. Now, this is very risky, as I will demonstrate in the next trade, which is with Shopify, which didn't work out the way I planned. So basically, I thought that Shopify, after releasing earnings, the stock would go up. So before they announced earnings, I sold a Shopify put for $992, and then I purchased a call for $21.27. Now, in hindsight, this was probably too much, and I was being too greedy because I paid a net premium of 1,135, which means I could actually lose a lot of money. And as I mentioned on Twitter, the plan is to close out my position just like with MetaFast and make a profit if the stock moves up. However, if the stock moves down against me, then I will just sell the call option, but then I'll just keep the put option. which I have a strike of 360. And I chose 360 because I think that's low enough where I don't think the stock will actually fall to that level because it was trading at around 460 at the time. So a $100 drop it's possible, but not very likely. However, if I do pick it up for 360, then that will lower my cost basis because I already bought Shopify at $580 before. So unfortunately, they missed top line and bottom line when they released earnings, and the stock basically fell to like 400, which is a large, like 15% drop on that day. Now, that was on Thursday where the big market drop happened. So I think half of this, like 15% decrease, is just because of market sentiment. And the reason I say that is because one of Shopify's competitors, Amazon, it was also down over 7% on that day. So I feel like the bad earnings did contribute to maybe like half of it, but the other half of the reason why it was down 15, 16% is just because people are really not liking these e-commerce businesses, these growth stocks at this time. So as I explained in my plan, what I did was sell my call option and I received $260, which is not as much as I would like. And the total loss for this trade is $875. So that's why you don't want to bite off more than you can chew. Like, I'm okay losing like even $1,000 would be okay for this trade. But if you don't have the liquidity or the size of a portfolio that will allow you to lose so much money, then you want to choose a call option to buy in the beginning with a lower premium so you're not paying so much for it. And I did do one more risk reversal last week, and that was with the company Block or Square. And I talked about this company before. It was on my buying list for a few months now, and I just kept waiting to get in. And I've sold some put options on this before, but they never got filled. However, the stock right now, it seemed to be at a price where I'm comfortable buying it. So I bought two risk reversals for this company Block. And it was a 85 and 105 risk reversal. So that's the prices for the put and the call option. And the next day after earnings, the stock didn't really move too much. So what I did was decided to just sell the call option, and I was able to get $930 back from that. So overall, the net premiums that I earned from this trade was $1,266 minus a few dollars for commission. But overall, I'm pretty happy with that. Of course, I still do have the short put on it, but I was going to write a put option at $85 anyway, so I don't mind holding on to this option. If I take a look at the stock in interactive brokers, I'm using Fundamentals Explorer here. Almost all of the analysts are giving this stock a buy recommendation right now. And if I were to just look at the highest rank analysts, you can see their price targets. This is what Square will be 1 year from now. It's pretty much all in the 150 range or higher. We can see that in 2018, one of the highest points was at $94. What were the fundamentals behind the company? Well, let's take a look. In 2018, people were willing to pay $94, and it was making about $3.3 billion in revenue. And it wasn't profitable yet. Its earnings per share were negative, and its return on invested capital was also negative. So investors uh, couldn't expect to actually make money and get a return with their investment. So, what about today? Let's look at the financials of Square now. It made over $17 billion in revenue. So, that's much more than before, like many times than 2018. And unlike in 2018, the company is now profitable. It has a positive earnings per share, and the return on invested capital is now positive. Free cash flow, it's making $713 million, at least last year, compared to 2018, 232. So again, that's like three times as much. And what are people willing to pay for Block today? Well, $96. So pretty much the same as what people were willing to pay back in 2018. However, as we just saw, the financials are so much better for this company now, and yet we're at that same price. In terms of where it could fall to, I think it's going to be around this level here because that's kind of the bottom of this wick here of that candle dropping before bouncing back up. And it also shows some nice support level here. So before it went up and down, up and down. Once it broke past this point, it just kept going up from there. So it's very unlikely that it will fall below this line, which is at about $85, which is the put strike that I have sold on this. So that's why I kept that option open. So if the price does fall below, then I would gladly pay $85 per share because I think that would be a very good deal for this company long term. Because short term, I mean, it could fall to $50. Like that would be if it breaks that $85 line and it keeps falling, that's the next support line is around $50, $60, roughly in that area. And it's going to trade within probably this range, just like before from 2018 to 2020. It was trading around that range. So it might do that again. That's not likely in this case. However, if it does and the company is still continuing to grow, then I would be happy holding it for as long as it takes for it to bounce back up. Because if we look at this price to sale again, it was trading at 20 and now it's at 3. And 3 is probably the lowest it's going to get, right? So if it does fall to $50 from today, then that would be a price to sale of 1.5. Possible, but just I can't really see it going down to 1.5 times sale and it's staying there for a long time. So eventually, I do expect the price of sale to go back up. And even if it goes to like a 5, let's say, that's like a 60% plus return on your investment right there, even if the company fundamentals don't change at all, which doesn't seem to be the case because they are growing. If we look at this Argus stock report and we go down here to 5-year EPS growth forecast, they're expected to grow at 40% per year on the EPS side. So you can see in 2023, it's already expected to make about $2 if you add up all of the quarters together. And in 2024, it's probably going to be around $3. And there's lots of companies like this. I've mentioned Google before, Alphabet stock. There's no guarantees, but there's a really good chance that you're going to make like 20 or 30% return if you buy Google right now in like a year. Google right now is definitely a really good buy. So is Square. I'm just being a little bit more conservative and I would buy it at $85, which is why I have the put. But even at $95 right now, if you want to pick up like 10 shares or something, I don't think that's going to be a bad decision as long as you have like a few years to wait it out as the market recovers. So remember to zoom out and understand that what you're buying is the future profitability of individual companies and not just a number. So as long as the companies you're buying have strong fundamentals and they are dominant in their industry and they have pricing power, then there's no reason why you can't just hold on to them. Even like 1 year from now, let's say in the spring of 2023, you're not going to be looking at your portfolio and think, oh, on like May 4th, my stock went up 5%, and then the next day it dropped 6%. What you're going to be thinking instead is, wow, in May of 2022, that was a pretty good buying opportunity. And I'm glad I averaged in and bought some stocks at that time. So anyway, those are just some of my thoughts. I hope everyone is still doing well and not too bummed out by the markets recently. Let's see where the inflation numbers actually land next week, and I'll talk to you in the next one.